Well, hey there, everyone. Happy Monday, December 15th, 2025, and welcome to Chart This with Dave Keller. We're coming to you from an atmospheric river in Redmond, Washington. That is a phrase I did not know a lot about until times like these, when I learned how ski slopes can all of a sudden run out of snow. Why rivers, which are normally kind of calm and wonderful, end up swelling and flooding entire valleys. Atmospheric rivers are a big deal, and a ton of wind, which we're not used to having here. The good news about this area of the country, we have more evergreen trees. If you're not familiar with this area of the country, more evergreen trees than you ever could possibly imagine. They're here. That's why states have names like the Evergreen State. Tons of pine trees. Problem is, these big, huge pine trees plus a ton of wind, it causes a lot of pine trees coming down, and that can cause havoc. So fingers crossed, the internet's remains strong and thriving here in Redmond, Washington. We're able to continue to bring you some context and observations through the course of this week and for many, many moons beyond. Hope you guys are all doing well, coming out of a successful and a happy and restful weekend. You know, today, kind of a quiet day, to be honest with you. There's some movement underneath the hood, and we'll talk about how sectors like healthcare continue to thrive, how a sector like technology continues to underwhelm, how the Dow is outperforming the Nasdaq. And I think that's going to be more the rule, not the exception going forward. This change of character that we've been talking about, I think, very real. And you're seeing that in names like Oracle and Broadcom continuing to weaken. You're seeing that in names like Meta not being able to recover after the recent pullback. Stocks like Microsoft testing their 200-day moving average. But there are other stocks that are working just fine. There are stocks that are actually rotating higher in the last week, while technology has been struggling. So we will continue to track this change of character for sure. And let's get to the market update. As a reminder, if you've not seen the show much before, three general parts to the show. First off, we'll just look at what happened to the major averages and other key asset classes today. Have some quick initial observations on what we learned. We'll look at a heat map called the market carpet on stock charts, where we'll assess more at the sector, group, and stock level where some movements have occurred that you may or may not be familiar with. And then finally, we'll look at a series of charts that I've hand selected through the course of the day today. You know, as a reminder, the goal of this recap show is to be educational, right? To inform, to help you understand what's happened, to give you context, and just to help you understand what some of these moves might mean. Try to separate the signal from the noise, which I think is a great way to think about it. There's a lot of noise in the modern financial age, but we'll try to focus on the actionable perspectives and ideas to think about. Hopefully give you some tools and techniques in the technical analysis toolkit along the way as well. All right, here's the major averages. Friday, obviously sort of a big drop out of the open. Today, a similar kind of vibe with a higher open, but then an initial sell-off. First hour, just as weak as we saw on Friday's session. We never really recovered today, so the S&P did finish slightly below where we closed on Friday, only down less than 0.25%, so not a huge down day, but we're down just above 68.16 at the close. The Dow almost made it to the green for the day. Didn't quite recover the sell-off out of the open. Did make it back to the starting point. So essentially no change from yesterday, from Friday's session. The Nasdaq, though, continuing to underperform. So while the S&P and the Dow had that late-stage rally, look how the Nasdaq composite kind of sold off in the last hour, while the S&P and the Dow in the afternoon kind of appreciated, particularly the Dow kind of trending higher from about 1:30 Eastern on. Same time period in the Nasdaq from 2 o'clock on, we finished more at the lows of the day. So the Nasdaq composite down at 0.6%. Mid caps and small caps all down as well. Large over small was a general way of thinking about this market, but small caps really weren't down that much. And then the VIX actually moving higher. We saw the VIX spike up almost to 18 on Friday. We didn't quite get that high today. We did push briefly above 17, but ended the day around 16.5. So 16 handle, still a pretty low volatility environment. This basically means we should be having pretty low percentage swings. We shouldn't have days with big moves over 1%. At least that's not what the options market is pricing in. That's why a spike in volatility here would be a pretty bad sign, because that would most likely imply options traders seeing a higher risk of bigger swings in price, which usually means swinging downwards, right? And sort of go into more of a risk-off phase. For now, VIX remaining fairly low, well below 20, which is kind of our back of the envelope level to watch. Looking at interest rates, you're going to see the 10-year yield pushing generally higher today. The 10-year, generally lower today. It sort of went higher through the course of the day, but the 10-year yield finished a little lower, just below 4.2%. The long bond yield is around 4.85. The 5-year point almost to 3.75. It's around 3.73, and those are all down from where we were Friday. Not a ton of movement in the bond markets by the close, but out of the open, bonds actually opened much higher and actually sold off through the course of the day. So the TLT finished not too far from where we finished the session on Friday. And the dollar index ended up rallying in the sort of midday session, ended up basically flat for the day as well. So with all the movements today, a lot of the major indexes finished kind of neutral. Arguably showing indecision more than anything. Not a lot of upside or downside follow through. Plenty of movements in precious metals. Gold actually ended up being just slightly up on the day, but silver continuing to outperform gold. That's been one of the, I think, key changes that we've observed. Gold and silver have both done well, but silver has really accelerated to the upside in the last month. Gold still in a positive structure, but not really breaking out as significantly. Gold is still sort of transitioning through this consolidation phase. Silver clearly breaking out and accelerating to the upside. The SLV was up another 3.6% today. Not as strong in the energy space. Crude oil prices were down. Natural gas prices were down. So the energy part of the commodity space, not great. Cryptocurrencies continuing to deteriorate. I actually sold more Bitcoin today. I'm not a big enough of a whale to cause that kind of move on your chart, but I was part of that in some way, unwinding the remaining position that I have. I'm not going to have much left at the end of this week, I don't think. I'm just seeing deterioration. While I think there could be long-term potential in cryptocurrencies, I've seen enough of the clear distribution phase that for me tells me best to wait and re-add a position when the chart looks more constructive. I did grab a chart of Bitcoin, so you can see today's rollover really feels like a new acceleration to the downside. Over the weekend, we're kind of in the 92,000 range for much of the weekend. Going into the equity session, we're pushing around 90,000, but sold off through the equity session today. Currently trading just below 86K on Bitcoin. You can see the top 10 coins all in the red today. All right, looking at the 11 S&P sectors, way more up than down. It's so interesting, right? If you finish your analysis just looking at the high-level indexes and what they did, seems like a pretty rough day or just an uneventful day. But then you look at the sector level and you can see that 8 out of the 11 S&P sectors finished in the green. 8 out of the 11 S&P sectors are positive today. It's pretty good. Healthcare up 1.3%. So the XLV remaining one of the strongest sector plays that we can detect. Utilities, traditionally more of a defensive play, but showing some characteristics of growthiness here recently, up 0.9%. Consumer discretionary, the XLY, up about the same, and that's third from the top. On the bottom, only 3 of the S&P sectors down. Technology continuing to lag in the month of December. Energy, number 2 from the bottom. Materials, basically flat for the day, not much change. So tech and energy really leading the way lower. Breadth, not great today, but not horrible, but depending on where you look. Now, the Nasdaq breadth was pretty negative. Obviously, there's been, there's a continuing rotation away from technology and related stocks. That sort of AI trade is really fizzling in so many ways. And while there are charts like Alphabet still kind of fighting the good fight, remaining right around the 21-day EMA, a lot of stocks in that AI basket have broken down pretty big. The Nasdaq Composite, 65% of that exchange down today versus 32% higher. On the New York Composite Index, a little more closer to neutral, 50% down, 47% up. In the S&P, the actually breadth was a lot more positive, 57% up to 42% down. So the growthier you were today, probably the worse your day was. And this is sort of the condition I find myself in evaluating market conditions. Sort of the further away you are from growth, the more interesting I'm finding the charts, the more improving I'm finding the charts for sure. And we could very much be in that weird scenario where the S&P and the Nasdaq, the S&P could be kind of flat, the Nasdaq could be down, the Dow could be higher, and plenty of stocks like healthcare and like financials and industrials could look quite good. And that is a very real scenario because they're not a big enough weight even if they all do well, it's not a big enough weight to drag the S&P and the Nasdaq up. They can't counterbalance any big negativity in the growthy sectors, which are just so big. So technology being down today, not hurting the breadth as much, but definitely hurting the major indexes. Looking at the Magnificent Seven and friends, these leading growth stocks, Tesla up 3.6% today. That's your best performer. I mean, things I did not see coming. Tesla being the obvious, only stock out of this basket making new all-time highs today. Tesla, right? If you told me a month ago, pick which one of these is going to be the only one making a new all-time high the third week in December, I would not have picked Tesla. I would have picked Alphabet probably, or Apple maybe, but not Tesla. Tesla has really started to improve and continues to be an outlier, right? Finally, like Nvidia and Broadcom and Amazon and Microsoft are all kind of Meta are all struggling. And then here's Tesla, sort of rotating higher and breaking out of a consolidation phase. It's impressive. I think I did grab that chart to look at and just show how it differentiates from the other Mag 7 stocks. Nvidia, though, having a positive day. Nvidia, not a great chart, really did not participate in that last move higher on a lot of the AI names, continuing to be relatively weak, but up about 0.75% today. Meta, which is struggling to find its footing kind of mid-range of the last 6 months, up about 0.6%. On the downside, though, Broadcom continuing to trade lower after Friday's downside gap. Broadcom continues to disappoint. No buyers coming in right now, and thrilled to accumulate Broadcom at a discount. I think that tells you about the lack of enthusiasm about their their reports last week. Basically implying, I think that's the risk to the AI trade, is that companies like Broadcom come out and say, yeah, we're not making as much in terms of revenues and or earnings as we would like, given all of these things we're doing for AI. And while AI could eventually be a transformative, life-changing technology, and I think there's no denying that that's where we're eventually headed, doesn't necessarily mean Broadcom's a good buy right now. And I think that's what we're seeing, is maybe a disconnect between the euphoria about the technology and the evolution versus the euphoria about this particular stock and this particular company able to make money today based on these things. And that's where I think there's a bit of a disconnection here. Amazon and Apple both down about 1.5%, as was Netflix. All right, we'll continue on looking at the market carpet. As a reminder, we do this market recap show every weekday after the close. We are very thankful that you're watching. We are super thankful that you take time to ask a question. We've received so many thoughtful questions from you guys over the year here. As I spend some time at year end to reflect on what happened this year, I'm going to be very thankful about what this show has meant in terms of sharing ideas and insights, but also the great interaction I've had from all of you guys. Please keep the great questions coming. We did an all mailbag episode on Friday, and if you missed that one, I hope you can go review it when you have time. Some timeless questions answered, I hope, about technical analysis tools, about market structure and things like that. So please take a moment, and if you have a question about anything chart related, behavioral finance related, individual tickers you're struggling with, use the comment section on our YouTube channel. We'll look for those questions and hope to answer maybe in our next mailbag episode, which will be this Friday. All right, looking at the heat map. I mean, so this is the general trend we've observed now in December. It's like technology, a lot of red, or certainly more red than other sectors. There are pockets of challenges in each of the sectors, but elsewhere looks stronger, right? I mean, if I compare the general complexion of healthcare versus tech, healthcare clearly more positive, as is consumer discretionary, as is consumer staples, to be totally honest with you, as is utilities, as is real estate. For this day, at least, I'm seeing a lot more sort of impressive complexion to this heat map in elsewhere than I'm seeing in technology. 2 of the 3 largest names and 4 of the 5 largest names all down today. Apple, Microsoft, Broadcom, and Oracle all getting dinged. Now, Apple is not far off of previous all-time highs, but certainly at the very least in a pullback, maybe making a higher low, as is Alphabet, but for now, pulling back here. Microsoft threatening the 200-day moving average. It's actively testing it. But then you have like Broadcom and Oracle, which are arguably pretty challenged. Broadcom is testing swing lows. Oracle is just in a clear downtrend of lower highs and lower lows. The stocks that have been going up, like Micron, we talked about that, I think, on Thursday of last week, making higher highs on weaker momentum. So we're seeing a clear bearish momentum divergence on some of those names that have been doing well. And it's just not just Micron, right? I mean, this is LRCX, Lam Research, which is one of the other semiconductor names. Look at the higher highs, October, November, December. Look at the weaker momentum. So every new high is marked by weaker momentum. Now, that can resolve in a positive way. We actually saw that back here in September. We had a bearish divergence in July and August. We never really had much of a breakdown. We kept making higher lows. Finally, we break out on stronger momentum. That negates that divergence and suggests a new impulse move to the upside. If you're bullish here going into the new year, that's what you would need to see here to resolve that divergence in a positive way. What often happens is the opposite, where the weakening momentum implies that there's less optimism, less bullish support for these higher highs, and all of a sudden the price starts to rotate lower and matches the message of the weaker momentum. So unclear which of those would happen, but this sort of divergence in Micron, LRCX, and some of the other semiconductors certainly has us thinking a little more cautiously about the uptrends that have seemed to be just a given for this market in the last couple of quarters. Maybe having a question mark. Within the consumer discretionary sector, I'd highlight the cruise lines, NCLH, Royal Caribbean, Carnival Cruise Lines, all rotating higher. I actually just sent my weekly show on Stock Charts TV over to the editing team there. So look for that probably tomorrow morning. But we dug a little bit into Carnival and also MasterCard, looking at a potential rotation from a bearish trajectory to a bullish trajectory. And I can walk through some of those things. I do walk through some of those things on the video, but cruise lines generally starting to rotate higher. Hotels, another travel and tourism, right? Marriott, Airbnb, Booking. These are all stocks making new swing highs, last week into this week. Hilton is in that list. So impressive upside rotation in some of the consumer discretionary names, some of which have not been particularly good. Like Booking has not had a pretty good run for about 6 months, but all of a sudden in the last couple of weeks, really reversing to the upside in a pretty meaningful way. Also good to see some of the improvement in the pharmaceutical group. So Eli Lilly is one, and I'm noting Eli Lilly because it's right around a big round number of 1,000. This might seem like a silly thing. This might seem like a gimmicky thing. I'll be honest with you. I've seen academic research that shows how big round numbers tend to have meaning. They even went to the granular trade by trade data years ago and looked at how trades would cluster around big round numbers. And so there's evidence that big round numbers tend to impact the market, meaning when we sell off and get to $1,000 a share, I would argue there's a psychological kind of behavioral reason, which is people look at a chart like this or a stock like this and say, is Eli Lilly really less than $1,000 a share? Like, no. And that's the reason to buy it. Same thing when you see things rally to $1,000, you often see a pullback. That happened with Apple when it first hit $1,000 a share before adjustments and all of that. So not surprising to see just a dip below 1,000 and then a rotation higher. Nice upswing today, maybe making a higher low and continuing that long-term uptrend. Pharmaceuticals have been selling off the first couple weeks in December. Now starting to show a little bit more strength, which I think is encouraging. I think that's it for the sectors. As always, when in this kind of environment, if you're nervous about market conditions, if you're nervous about the weakness in tech and are wondering, is this some sort of major top? I mean, there are things we look at, and I'll share with you some of the charts here in a moment, but I would point out defensive sectors always helpful. Consumer staples, utilities, real estate, healthcare, I'd put in that bucket. The stronger those sectors are, particularly on a relative basis, that can tell you that big institutional investors are getting more defensive. We're not seeing enough of that to, I think, be a big red flag, but certainly something to think about. All right, we're going to look at some charts here to finish off today's episode. I appreciate you so much tuning in. I also would appreciate if you would join me for my next free webcast. Love doing the webcast. It's an interactive session. We'll spend about an hour together. Comment lines, the chat room will be open. You will be welcome to ask questions along the way. If you miss some of the live nature, we used to do live Q&A on this show. Please join me for the live for this next live session. It should be a lot of fun. You can find more info at marketmisbehavior.com/lessons. The event is called Winners, Losers, and Lessons, your year-end investment review. This is a session that is built on my normal annual process at the end of every year. I ask myself 10 questions as an investor. Some of them are related to my performance, looking at successful trades and not so successful trades. Some of them are looking at process, how I'm spending my time, what I'm doing every day, every week for my routines, looking at missed opportunities, thinking about mindset. It is a really natural time of year to kind of take a step back and reflect on how you've grown as an investor, and then really start to think about how you want to grow as an investor in the year to come. I hope you'll join me for that free session. You can sign up at marketmisbehavior.com/lessons. And again, if you sign up, you can participate live, ask questions as we go. It's usually a really good interactive session. I hope you can participate. And if you can't make it live, don't worry. Just make sure you sign up. And as soon as the replay is ready, I'll email it out to all of you. As long as you signed up for the session, you'll be able to get to it. All right, folks. Shall we continue on and look at some charts together? This traffic light that we set up here in the last couple of weeks, still pretty relevant, I would say. We talked about, thinking of the S&P 500 kind of like a stoplight. Generally speaking, we're range bound. I would say the S&P right now is no longer in an accumulation phase, in an uptrend. And it's definitely not in a distribution phase or a downtrend. I think it's in a sideways or consolidation phase, which is that third direction, right? The market's going sideways here. We're right now exactly where we were right around the end of October, right around Halloween. We're pretty much at this level. So we haven't gone anywhere. We've just been chopping around. So what would tell us that we're in a new trend in one direction or the other? I think the S&P above 6,900, green light, we're in a new bullish trend. That's pretty bullish. That tells me 7,000 is probably reachable maybe into January. Would be a pretty optimistic way to set up the new year. Anything below 6,550, I think that's a red light for me. That tells me to get pretty defensive. That's when I would start getting more, starting to lighten up on an equity allocation, go to more risk-averse positioning or capital preservation kind of things. And then that means the yellow light is anything between 6,550 and 6,900. I think it's more of a stock picker's opportunity. I think you just want to find tactical opportunities that look good. It's always a good time to own good charts. So let's just focus on finding some good charts. And with our allocation, let's make sure we allocate to the best opportunities. And if you've been riding the AI wave higher through 2025, I don't blame you. It's been a fantastic trade. Is this the time to be lightening up and going to other places? Hopefully, it's something you've been thinking about before today, because we've been talking about that rotation away from growth and into value. And I think we're starting to see that really materialize here. I think there's going to be more of that going into the new year, if you ask me. But for now, I think we're in a yellow light sort of wait and see mode. What we saw on Friday and then again today, we're closing near the lows of the day. That means the volume's thought of as more distributive volume. It's more distribution kind of sense. So we'll see if that continues. For now, we're kind of hanging in there. And this most recent rally, make note, the S&P didn't get much above 60, which is not an encouraging sign for the bulls. Our market trend model, which is uses weekly data on the S&P, did remain bullish on all time frames as of Friday's close. I keep an eye on this during the week, but I really formally make any changes only after Friday's close. I do that once a week, and that's an intentional way of just ignoring the noise during the week and just having a long-term trend following strategy built on a weekly assessment of conditions using the weekly chart of the S&P. And for my premium members, we actually apply this market trend model to a bunch of different asset classes and ETFs. But the main one that we're highlighting here uses the S&P 500. Last Friday, the short-term model very close to going below zero. We've had 3 1-week only moments where the short-term model did rotate below zero. Each one of those times in July, in late September, and then in mid-November ended up being buyable dips as we pulled back and made a new swing high. This, if we would rotate below the zero level, it's not quite there yet, but it's getting very, very close after today's slight drop. That would be the 4th time since the April market low when the short-term model has gone negative. These previous pullbacks have been buyable pullbacks. Is this time different? We'll have to use a lot of other tools to assess that, but for what it's worth, that's something we're observing. Lots of stocks above moving averages. And when you think about breadth conditions, the breadth's not bad. It really isn't. The short-term breadth in particular has improved quite a bit. And I think this is one of those scenarios where stronger breadth probably most likely means in this environment that the S&P may end up going lower. We could see the S&P and certainly the Nasdaq go lower, even though breadth conditions remain strong. That would be the case if it is a rally driven by things like financials and industrials and materials. These are sectors that are not nearly as big of a weight as technology or something like that. Technology is about 35% of the S&P. So if tech is down and those other value sectors are up, the major indexes could be down, even though breadth conditions could remain quite strong. So the breadth conditions are telling you conditions are good. I think that means the S&P could still be vulnerable if you see further weakness in tech. I think it's still vitally important that we pay attention to that area of the market. Newer Dow theory, just to remind you, giving a big divergence here. This is called a bearish non-confirmation. Unless we get a big upturn here through the remainder of this week on the equal-weighted Nasdaq 100 to match the equal-weighted S&P's new all-time high that we saw last Thursday, unless that happens, then we have new highs in one and not confirming new highs in the second one. That's a bearish non-confirmation. We've had a couple of those since the April low. In the previous occurrences, which are shown by these dotted lines here, the market has resolved higher because both of those have eventually made new highs. But that's what we would need to see here for an all clear after this bearish non-confirmation. Here's the VIX. The volatility remains pretty low. And when you ask me, like, what tells you to not be too concerned, I would say volatility remaining fairly low is a pretty good sign. The VIX basically measures volatility in the options market, the S&P index options market. And when options traders are perceiving greater volatility in the underlying asset, the VIX starts to spike higher because it implies that there's an expectation of greater movement. Options market right now is telling you the S&P is in a low volatility environment, not anticipating big swings. So that's kind of a classic bullish configuration. Low volatility usually means we're grinding higher. Any spike in the VIX here would probably be a really negative sign. One of the ways I like to look at that is to compare it to high yield spreads. These are credit spreads or spreads based on the bonds of junk bonds of risky companies or high yield companies. Spreads still remain pretty narrow, right? We're still at some of the lowest levels we've seen since the April market low. You can see how wide spreads got in at the April low. And again, this is plotted inversely so that it matches more the relative movements of the S&P 500 index. So if the spreads widen, the line's going down, and that usually means stocks are weakening. So at this point, spreads remain pretty narrow. Volatility remains fairly low. S&P remains in pretty decent shape. But that would also mean, I guess, that the next potential step, widening spreads, increasing volatility, most likely means a risk-off move for stocks. That's something to watch. Here's the chart of Bitcoin. Now, last week on the show, we highlighted this trend line, which is basically, showing what's kind of a bull flag pattern. It's not a perfect bull flag, but pretty close. Right? We've had this big sell-off from 125 down to around 80,000. We now rallied up to almost 95,000, but that short-term pattern looks like a bear flag, and a break below that trend line suggests much further downside. I mean, it's not awesome how big. I mean, that suggests a move down around probably 50,000. Would be my initial assessment. This is me just glancing at the chart. I could probably do a more thorough downside target, but that's about what that means. So we break down below that flag. It's really not a good sign unless we would start to see some stability in this 80 to 85,000 range. The momentum has taken a big negative turn. We saw a much more positive turn in April, which was a sign that we were recovering off of those lows. We're not getting those recovery signs. We're seeing more downside momentum. Charts like this are what tell me to continue to lighten up. The remaining position I have in Bitcoin and Ethereum, I've unwound a lot of that and have tried to share that with you when I remember to do so. But that's where I'm at right now. All right, so what else can we look at? Growth sectors. Here's technology in the top, communication services, consumer discretionary. We're not just talking about the individual sector ETF, but the relative performance of the sector ETF versus the benchmark. If you look at what's happened in the last 3 months, technology has really diverged from the other two growth sectors, right? So when technology has been outperforming in September and October, communication services underperforming, consumer discretionary underperforming. All of a sudden, they all start to rally here mid-November to early December. They all start to rotate higher. But once again, we're diverging. Technology has now underperformed over the last week. Communication services and consumer discretionary actually continuing higher. So it sort of feels not like three growth sectors, but tech and then two other growth sectors. And they're kind of moving in opposition to one another. So the weakness in tech starting to be matched by relative strength in communication services and consumer discretionary. And as we highlighted on the heat map today, that's where I'm finding some pretty compelling charts. Carnival Cruise Lines is one, CCL that comes to mind there. Here's what's happening with some of the semiconductors. Not much of a bearish divergence, but still technically a one in October, November, and December with weaker momentum on those new highs. But just today, on Friday, Broadcom gapped lower after their news announcement, hit the 50-day moving average today. The question over the weekend was, do you see buyers coming in thrilled to have a discount on Broadcom, getting a $50 off coupon on a share of Broadcom? Didn't happen. Today you saw further deterioration, down another 5.5%. RSI dipping just below 40 today. I think that could be crucial to watch, because if we see further deterioration on weaker momentum, that's the sign of a distribution phase. So keep an eye on these swing lows. It's around 325 to 330. That's just below today's low. I think a break below that would be pretty negative. I'm setting an alert. Broadcom below, we'll call it 325. That would be something I would want to know about. Tesla, I mean, again, if you asked me a month ago, which of these stocks is going to make a new, all-time high on December 15th, and your choices are Apple, Meta, or Tesla, I don't know which. I mean, I'm sure my guess would have been Alphabet, because it's been the strongest technical configuration, but it definitely wouldn't have been Tesla. Given a big list of stocks, I'm pretty sure it wouldn't have been Tesla, because a month ago, we're making new swing lows. We're undercutting 410. We're breaking below support. Things look pretty rough. Now, what's interesting is, even though we did make a briefly lower low, the RSI did hold 40, which is sort of an encouraging sign that we're still stable. All of a sudden, this looks like a big basing pattern, sort of a sideways pattern where the resistance around 470 remains very stable. All of a sudden, just today, we're breaking above that 470 level, making a new all-time high on Tesla. As always, you want to see follow-through. You want to see if there's further appreciation tomorrow. But I like the fact that we're breaking out with the RSI pushing above 60. That's pretty encouraging. I had a question from one of my market misbehavior premium members about the Crane Shares CSI China Internet ETF, ticker KWEB. I usually look at like the FXI or MCHI are the ones that I look at more often. But this is more of an internet-specific, China Internet name as opposed to like a broad Chinese ETF. Testing the 200-day moving average. So what's good about this is we're holding the 200-day moving average. The bad news is today we closed below it. The real bad news is the momentum is clearly negative. So we're making a pattern of lower lows and lower highs. We're below the 21-day EMA and the 50-day simple moving average. The 200 days is the last level. That held back here in January. That held essentially back here in April, held in November. And the question is, does it hold here? The momentum, the weaker relative strength tell me this is not a great chart, and I probably want to be waiting for signs of accumulation. But for now, no real signs yet. Breaks below 36, which is where I will set that alert right now. I think that would be a really bad sign for KWEB. And again, that's names like, what are the names in KWEB? I should know that off the top of my head. Alibaba would be one that comes to mind. PDD, Baidu. I can look it up. I don't have to just guess. That's the benefit of having this. Oh, yeah. Okay, yeah. So I was right on some of those. Alibaba, Tencent Holdings, PDD. Not all of these have U.S. listings that are part of that. JD, right? JD.com. And then a number of other names that are kind of smaller weights. And the big weights, Alibaba, Tencent, Pinduoduo, PDD, Baidu. Those are the top four holdings. But Alibaba and Tencent, both over 10% of the portfolio or of the ETF, testing the 200-day moving average. So that group, that area of the Chinese market, looking a little less ideal right about now. Folks, that'll do it. That is our show for today. I want to thank you so much for joining me here on Chart This with Dave Keller. Please give a thought to joining me for my next live webcast. That'll be this Wednesday, December 17th, 1 p.m. Eastern, 10 a.m. Pacific time. You can sign up at marketmisbehavior.com/lessons. If you can't make it live, please sign up, and then I'll make sure I send you the replay as soon as it's ready to go. In the meantime, have an enjoyable Monday evening. I wish you much investing success today. And always, I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.